Um, Welcome, everyone. It's good to be here with you all. Um, I'm looking forward to an exciting webinar this morning. All right, so let's get started. My name is Gershon Margolis. I'm the founder of Imperial Advisory, and we are a fractional CFO firm. I'm going to tell you a drop about us, tell you a little bit about the topic, then I will introduce our excellent speakers, and then we can have some fun. All right, so who are we? In large organizations, CFO is often one of the CEO's most trusted advisors. For companies not quite at the size where they need a full-time CFO, using a fractional CFO gives them the same type of strategic guidance, advantage, benefits for as much time a week or a month as they need. By bringing an experienced CFO onto the team, CEOs, business owners get to spend less time worrying about strategic financial decisions and spend more time focusing on the actual business, boosting sales and profits. We pick up where accounting leaves off, and sometimes we'll even serve as a second set of hands for an existing CFO. By working with the team, with the CEO, with the CFO, et cetera, and analyzing company's performance, we're able to provide insights and empower the other stakeholders in the business to make more informed, big picture decisions and let them spend more of their time focusing on sales, operations, whatever it is that they want to be doing. Besides, we have a very experienced team. On average, our CFOs have over 30 years of experience, and many of our CFOs have held other roles in businesses besides CFO. And so we get involved in a variety, different parts of the business. We come in as the CFO, but we can help or at least be a sounding board on a variety of issues. And one of the things that we do, which definitely falls into the finance arena, but isn't always a day-to-day thing, is working on M&A, mergers and acquisitions. Something interesting that we've been working on recently is we've been getting a lot of standalone M&A deals where we're not the CFO, but we're just being brought in to help with financial and other types of due diligence. So that's an interesting new thing. But I would say more generally, when we set up this webinar, is the broader idea that M&A is often part of a business's growth strategy, not always, but certainly one of the components. And we bring a lot of that experience to the table and help our clients with that. And so this is really an educational webinar. We're hoping that you learn a lot. And yeah, so now I'm going to transition into telling you a drop about our speakers, and then we will kick it off. Bob, Doyle, and Jeff Berkman, we're very pleased to have them. Bob actually used to be my partner here at Imperial. He's an experienced CEO and CFO. Right now he runs the alternative board here in Nassau County, where he provides peer advisory boards, and him and his team work with business owners in that capacity. Though I imagine he's still involved in M&A, and we'll hear more about that. Bob, when he ran the company that he ran, which was CoinMac, I think they changed their name since then. They did many, many deals. They did numerous acquisitions, as well as sold the company. I think it was like 5 times, but I'm sure Bob will correct me if I got that number wrong. Anyway,
I lost track.
You lost track, okay. But very pleased to have Bob here. And we're also very pleased to have Jeff here. Jeff Berkman is an experienced corporate and M&A and probably other things attorney. He is the chair of the corporate department of Falcon Rapport Berkman. He's that Berkman. And it's one of the probably fastest growing law firms here on Long Island. I think that they're located about 10 minutes away from where I'm sitting right now. And he brings a wealth of knowledge, great experience, interesting background. And we've actually had Bob and Jeff before, and I'm very excited to have them both back today. So without further ado, Bob, please introduce yourself if I missed anything. I'm sure I did. And how did you get into M&A? And then,
Well, there's not much more to add to what you said. First of all, I want to thank. I look at the list of participants, and I want to thank all of the tab members that came out and joined this webinar. So I really appreciate the support. I know my email got out, I guess. It's but so I started. I had a very fortunate career in that I was able to work for 30 years for one company, but have various careers within that company as if I had moved around from business to business. What I mean by that is I started out in a family run business doing about $50 million in revenue, about 250 employees. I learned from the grandson of the founder how to run a company. How does an entrepreneur think about the numbers, their expenses, how to run a business? Great experience. The family ultimately exited. A PE firm ultimately came in, and we went off and just grew the company from $50 million ultimately to over $1 billion in revenue. All of that, most of that came through acquisition. We had about a 3% organic growth rate. So the rest of it came from acquisition. We bought family-run companies, we bought large companies, we bought small companies, we bought publicly held companies. We also changed our own ownership. We went public a few times. We went back private again. We sold to multiple PE firms. So I've had the incredible career and opportunity to stand in front of people who own their own businesses that were selling. I've had the opportunity to stand in front of Moody's and Standard and Poor's and talk about the economics of the business, be on Wall Street, talk to investors. So it was a tremendous experience, tremendous background. And I learned I've been through the diligence process, probably 100 times or more. So I love talking about it. It's a lot of fun. And, with that, I turn it over to Jeff.
Thanks, Bob. Yeah, so Jeff Berkman. As Gershon said, I am the chair of the Corporate Securities Department at Falcon Report Berkman. We are a firm with 55 plus lawyers, growing rapidly with offices in Long Island and New York City, Newport Beach, California, and Florida, and lawyers all across the country in multiple jurisdictions. So how did I get involved with M&A? Funny thing that we're having this webinar today, because yesterday I was having lunch with my old boss and now a dear friend of mine, who basically I was the general counsel of his loosely described venture capital firm. For years before that, I had sort of meandered around in big law and spent a fair amount of time with sort of 2 feet in different departments, one in in litigation and one in commercial matters, and started dabbling into corporate law more. And eventually I was hired as I said, general counsel of this loosely described venture firm, and we invested all around the world in startups and emerging companies in the early 2000s. So one of the second period of the internet. And got involved in these investments, doing a significant amount, obviously, of M&A acquisitions and sales, with accompanied by all the due diligence that goes on with that. So in that experience, both from a tech side, although we ended up getting involved with media, movies, and real estate, and running that department with portfolio assets around the world, I obviously did a significant amount of M&A, and then eventually had my own firm doing the same thing. And now at Falcon Report Berkman, obviously we have a very strong M&A presence, buy, sell, working with emerging and anything from lower to middle market companies. So with that, I'll turn it back over to Gershon, and we can delve into the topic a bit more.
All right. Thank you. Thank you both. So let's see. First question that we have here is actually going to Bob, and then Jeff, your follow up on this, and then we'll switch it up. What is due diligence, and why should we care? Why is this something that should be on a business owner's mind?
Yeah, sure. When you're buying a company or when you're selling a company, either way, it doesn't matter. Diligence is the process by which the prospective owner, purchaser, or the seller puts out all the information that they know about their company. You learn about the financials of the company, the projections. How is the company doing versus budget? How is the HR department built? What does the org chart look like? How does the company run? Are there policies and procedures? It goes all the way from financial through HR, through legal lawsuits, anything that a prospective new owner wants to learn from the old owner about the operations of that company because they're purchasing that organization. It's really important because, I mean, Jeff can speak better about this, but the inability to prepare good diligence or misleading diligence information ultimately will result in a lawsuit. That's one thing, but the other thing too is to go through from a what's in it for me perspective. As an owner of a company, as a seller, you want to get the most money you can for your organization, and it's just like anything else. When a buyer comes in and goes through your diligence process and finds out about your company, the less hiccups that you have in that diligence process, the more likely you are to not have somebody come back at you for purchase price adjustment. You've negotiated a multiple of EBITDA maybe, or a multiple of sales, or whatever you've negotiated in your LOI, and you've made certain representations. You say, this is based on these facts and circumstances. And then you're obligated to put together a full package. It can take, again, the more time you spend on this, the better your diligence package, the cleaner your acquisition goes, the easier it will close, and the less likelihood of purchase price adjustments.
I want to just say one thing before we bounce it over to Jeff. We had a deal, a number of deals we've been working on recently, but one of them, the buyer was basically, the seller did not provide sufficient hadn't prepared properly. And so the buyer was paying, and we were doing all sorts of research and getting what we could from the seller. And eventually the buyer pulled the plug and said, it could be everything the seller is saying is true, but it's taken us X amount of dollars so far, and we don't know what we're going to find, and we're kind of tired of spending money trying to figure this stuff out. And had the seller had their ducks in line and had everything in order ahead of time, the buyer might have bought, they might have not bought it, but in this case, they didn't even finish looking at it because they're just like, we're not interested anymore.
Mm-hmm. Yeah, the easier you can make the transaction flow, the more likely you are to close it. I mean, there's always deal risk. The longer a deal goes on, the more likely it's going to fall apart, right? So one way to really make it go fast is to have a nice, well thought out and clean diligence process. And I mean, I think we may have this later on, but I mean, some companies do pre-diligence. They go out and they'll put together a package, and they'll even bring in an accounting firm to do a quality of earnings review and say, when somebody comes to buy my company, what are they going to find? It's a lot like selling a house. When I sold my last house, I brought an engineer in before I even put the house on the market, so I could preemptively repair anything that an engineer was going to find, right? And it just makes the buyer feel that much more comfortable. It's no different here. It's just the numbers are bigger.
Yeah, so let's talk about that a little bit, because it's, the question started out, what is due diligence, right? I think probably most people, if not everyone on this phone, generally knows what that is. But look, we do due diligence in our lives on a daily basis, right? You're going to go buy a television, you're going to buy some electronics, you go out, you look at websites, look at the reviews or whatever it is. So due diligence, on a business, is just that on steroids, right? So what Bob is saying makes incredible sense. That I tell clients, do due diligence on yourself before someone does it on you, because inevitably, if you find issues, that's an excuse or a reason for the buyer, if you're in the selling transaction, to chisel away at the purchase price, or eventually walk away thinking that maybe there's a house of cards here. The way, due diligence, if it works the right way, if you do it ahead of time, if you get your ducks in order, it's all about maximizing value. It's maximizing the sales price. And that's really, like, you'll probably hear me say that more than once today, but that's really what the focus of due diligence should be. Cleaning up the mistakes or issues that you may have so that the process goes well, doesn't result in a reduction in a purchase price or kill the deal, and getting the most value out of it. Because if that's in order, the process goes through much better and a much more orderly process. You will end up in a transaction that you'll get more satisfaction out of, essentially. Whereas those where there are issues that come up are going to either be delayed or just, like I said, you could potentially kill the deal.
Do you have any stories on that, Jeff?
Yeah, I mean, I could think of one scenario, this was a number of years ago, but there was a scenario where these two partners had created a business, and one of them really created the IP and the other was sort of the marketing guru and had figured out how to monetize it. And in the course of their life together as business partners, the one who had not created the IP essentially bought out the stock of the other one, right? And then so down the road, a couple of years later, had really done an incredible job monetizing and showing a really strong EBITDA, and had somebody come along and wanted to buy the business. Well, it turned out that in the process of you would think buying the stock so you own the IP. The problem is the original owner never did a simple document that constituted the contribution of the IP to the business. Now you could say, like, by virtue of their relationship, that's what happened and all this. But the bottom line is it hadn't been done, and the other partner kind of caught wind, or the ex-partner caught wind of what was going on here and said, well, I never contributed that IP to the business. Show me a document where I did it. Whether that person was right or wrong doesn't matter. No buyer is going to go into that knowing that there's an issue. That and as a result, the whole deal was killed. I mean, there was a scenario actually when I, was involved in a different capacity, not in this firm, but I was representing the buyer in that transaction. We would never gone forward with something like that. If I was representing the seller, you would have made sure that prior to, again, getting your ducks in order, prior to any kind of transaction, you would have had the partner execute a simple IP contribution agreement. So that's just a prime example, but this stuff happens all the time. These type of issues come up all the time that can be addressed fairly simply if you think through them, long before you start, preparing, or before you get the offer on the table or whatever, or where you're looking at an opportunity to exit.
Thank you. Let's turn it over to the audience. Do any of you have a deal that you've been involved in or watched blow up? Barry, go ahead. You're on mute.
I was engaged by a wealthy industrialist in Switzerland to help him do due diligence on a magnesium smelter he wanted to purchase up in Canada. It was a magnificent smelter, cost about $700 million to build. It was halfway between Montreal and Quebec City. It was absolutely gorgeous. The only problem was they had built it in such a way that you could not change the ratio between remelting magnesium or doing original melt of magnesium. And the way the pricing went in the market, it looked very strange. So I sat down in the evening after our first due diligence meeting and did a quick model. And I found out, to my surprise, that there was no way this smelter would ever be profitable. Given the economics that existed, it would never work. So we went in the next day and we walked away. And about 6 months later, the owners tore down the smelter. They couldn't sell it. And there was a huge engineering mistake that we managed to pick up. And if we hadn't done a model, we wouldn't have known it. So that was my little story of a real intriguing one.
Yeah, I think, Gershon, I think it's
Barry.
worthwhile to take a second and walk people through the process of, like, when the due diligence occurs in the deal, because I think what you see as an outsourced CFO, and you can talk to this a little bit, is normally what happens, there's sort of the parties, the potential buyer and seller, they're exchanging, some original information. You get a teaser, they go over, they tell you what the business is about, they have their EBITDA, they tell you what they sort of negotiate a price, but they haven't really, got into the company. They haven't done any really true due diligence. And so they get to a sense of, as a buyer, of what the value is, what they want to offer for a purchase price. You know, there's a look, they look at the financials, things like that, but they haven't looked at any of the legal documents. They haven't really looked at anything that underlies the financials yet. So then if they go forward with an LOI, they sign that, and then they have the quality of earnings, right? The Q of E, right? The Q of E is going to walk through and make sure that the purchase price makes sense based on the financials, right? They're going to look at some other due diligence stuff in that process, but it still isn't the final full-blown due diligence. And then once that, they say, okay, look like we're ready to go ahead. Along the way, all that due diligence will continue. And so you can imagine from the process of, hey, here's a teaser, to, oh, now we're working on drafts of a purchase or transaction documents, due diligence is taking place this entire time. So anything that we're talking about here today could easily come up. It's not, and that's why we're saying, like, that whole due diligence process will continue most likely until the very day that you close. You know, most deals are signed and closed simultaneously. So up to 5 minutes before, someone could literally discover something. This is why you want to make sure, your clients, or if you're involved in it, are prepared for that process, because it could be really a daunting thing for sellers.
Thank you, Jeff. All right, I think that kind of covers our next question, right? When should we start thinking about it? And how do we get the company ready?
I've always said that you should start thinking about it the day you start your company, because what I find really interesting, I'll go back to my house sale example again. When I sold my last house, I went through and I repaired things, I painted, I refinished some of the floors, and all of a sudden I looked at the house and I said, hey, this is a pretty cool place. Why am I selling this? And a lot of the stuff that you do in diligence, the financial projections that you prepare, the way you look at, one of the things you look at is concentration, right? Customer concentration, risk factors, things like that a buyer is going to look at. When you go through and you study these things, and all of a sudden you find out, you've got a industry concentration or a customer concentration, or you've got something in your organization that you learned in the diligence process. Had you fixed that 10 years ago, you would have enjoyed running that company without that problem for all those years. If you find yourself writing operations manuals, if you find yourself documenting systems while you're going through a sale process, all of these things would have added value to your company the day you started it. So I think, most of the time, sometimes you start a company and hopefully your goal is to pass it on from generation to generation. But often the goal is ultimately to exit the business and to sell it. So I think the decisions that you make year 1, year 5, year 10 ultimately impact that exit value and the diligence process and the work that you've done to get there. So my answer is day 1. I mean, listen, Jeff can speak about this better than I can, but the tax decisions that you make, the biggest leakage on an acquisition is often the tax expense, right? And that all grows out of how did you structure the company when you formed it? What did you choose? What decisions did you make? And you got to think about what the basis is going to look like. Are you going to do a stock or an asset deal? Then I'll let Jeff go from here, because you know more about this than I do. But these are the decisions that happen early on that ultimately affect the diligence process many years later.
No, 100% agree. Look, I mean, it's the foundation of your business. Some of these decisions, one of them being tax. And if you're not well organized, if you haven't thought through, if you haven't spoken to somebody about tax planning, both, all along the way, from the beginning on the foundational issues, all along the process until the day you sell, then you're either not structuring it the right way, or you're leaving money on the table as a result of tax inefficiencies. We often tell clients, because we have a huge trust and estate, asset protection, and tax department here. We tell clients, like, if you're at all thinking at any point of selling, if you have, even if it's years down the road, like, let us know now, because there are things you can do along the way often that will make it more efficient from the standpoint of taxes. So yes, I agree with Bob. It's like, from the beginning, these issues need to be addressed. Tax is primary, but there are others that you need to be addressing. Your contracts your website. I could think of a million things, and that's why in a transaction, a buyer will get a 20-page due diligence questionnaire, because these are the basics of running this business. So it's a process that starts from the beginning. It should be checked on along the way, and the more you do that, so I think about this. If the takeaway is due diligence done early on yourself will maximize value in a sale.
Jeff, you just mentioned something that we hadn't talked about when we were preparing for this, but contracts is a very big part of diligence. And one of the things you need to get a handle on very early is what contracts does your organization use? How important are they to the business? And are they assignable, right? And sometimes they're not assignable. Sometimes they're assignable with permission. Sometimes they're assignable that will not be unreasonably withheld. But these are issues that can really screw up a deal. Is when you get to the, if you have a lot of contracts, the good news is we've got lots of contract that protects our revenue. The bad news is we got to go talk to our customers now and tell them we're doing a transaction to see if they're assignable. Or if you do it after the closing, then you have to have a post-purchase price adjustment, where if you can't get those assignments, you end up losing a lot of the value. So contracts is huge especially in terms of revenue.
Now, Bob, if you have contracts that are not assignable and you sell the entire business, does that pose a problem? Can the acquiring business just own the target? And
this is a Jeff question. This goes back to what I talked about earlier. How did you form your company in the first place? Are you selling the operating company? Are you selling the parent company? Sometimes you can sell your organization without having a change of control impact the operating company, in which case the contracts just go. But it's more of a legal question than an operating.
Yeah, I know. I mean, Bob's right. It's a stock deal versus an asset deal. If you have a stock deal, you're buying a company. Sometimes though, contracts will have even change of control provisions that say it doesn't matter if you're selling the ownership of the business or more than 20%, then you're going to have to get approval of the vendor or whoever you have that relationship with. So it's not, one size fits all, or there's no one answer. Certainly in an asset deal, which you are buying contracts, you're buying customers, you're buying equipment, whatever it is. If those contracts are not assignable, it's going to be a problem, because if those customers represent your revenue, obviously it's going to be a problem. So these are things you need to be aware of ahead of time. Like the perfect example is a lease, right? I don't know when anybody has a lease, if it's a landlord, that says it's automatically assignable, unless you're a major company that can with deep pockets that can force that kind of provision in your contract. But in most cases, the landlord's going to want to know who's stepping into the shoes as the assignee or the owner of this business. So that's a prime example where if your lease says that this is not assignable or on a change of control, you need approval of the landlord, that could be a major issue, right? So this is why understanding your business, not just from the financials and everything else that go on, but from what goes on your legal side, on your contracts, on your relationships with customers, things like that, is essential, and can't wait until you get somebody who walks in and plops a lot of money in your lap.
got it. So back to the theme of starting early.
Gershon, there's another piece of diligence that isn't always so obvious. I'm not sure how much this happens in smaller deals, but in the larger deals, the purchaser will sometimes hire a research firm, and they'll go out and they'll find a way to contact your customers and contact your vendors and talk to the major people that you do business with and learn what it's like to work with you and what does your reputation look like. And I'm not sure how they do this without violating the confidentiality, but they do it. And as a management team, you have to be prepared to sit there and talk through some of these, some of these conversations go really well, and sometimes, not so well. And you need to address that, because again, it impacts the asset that somebody's purchasing.
Yeah, I mean, there's another thing I think, again, like talking about the process a little bit, because it can be daunting for a seller, right? Like they will get a purchase agreement that will have you know, depending on the nature of the business and the sort of the size of the deal, the nature of the deal, it could go on with reps and warranties for 10 plus or more pages, 20 pages. These reps and warranties are just sort of a one-off on what you're saying in your, you know, you're giving in your due diligence. So everything that you're going to have to prove the value and prove the legal issues on the due diligence from when the buyer is conducting that, you're going to have to rep in the agreement. Those reps go on, like I said, for pages, and some of them are very specific about things you're going to represent. Contracts is a big area, deferred comp plans, you know, employment, employer, employees. Like I was on this deal once where literally the call on just the ERISA issues went on for hours. And I could just see the client just seething as the seller saying like, why is this taking so long? We have XYZ as our, you know, outsourced PEO that deals with all this. And you got to understand from the buyer standpoint, they don't care what your contractual relationship is and your indemnification rights are with your PEO or your outsourced service that's providing the payroll. If it's not done right, if the payroll's not right, if the ERISA issues are, if there are ERISA issues, you can't even save a company at that point. It could be tens of hundreds of millions of dollars, depending on the nature of the company. So this is why like the process is what it is, and why being prepared, I don't know how many times you can say it, but like being prepared by having, you know, good advisors, your outsourced CFO, your, you know, your financial team lined up, your lawyer, your, you know, your risk specialist, whatever it may be, your ops person, like that team needs to be involved as soon as possible. And the earlier, the better.
All right, I think that's a good segue into our next thing, which is, so I hope there's no PO people here, but you know, you don't want to rely on the fact that someone did something right historically, right? Ultimately, the buck stops with you, the seller, right? And the buyer looks at you and says, I'm either comfortable or not comfortable. But when the seller is thinking of starting to think about due diligence and putting all this together, how much can they rely on their deal professionals? How much of that do they have to be doing on their own? Are there attorneys and CFO and CPA and the investment banker or broker? Are those guys going to take care of everything? Or is that something that, you know, those people are helping, but it's really the CEO's job, headache, et cetera?
Well, you know, a lot of it depends on the size of the company, right? If you're selling a small company and you want to keep it really close, it generally ends up with the CEO and or the CFO or the top financial person in the company. They end up doing a lot of the work. And in a smaller company, the attorney is often a very trusted advisor and is attached at the hip, and that all makes sense. In a larger organization, what we used to do is when we were doing an acquisition, we would create a deal team. You know, we would put together an ops person, a finance person, all through the organization, put together a deal team, and we would tell that team, you know, you need to sit down with your next in command and say, I'm not available for the next couple of months, and you're going to have to, if anything big comes, bring it to me, but act as if I'm not here. And those people need to be 100% dedicated to the process, because as Jeff mentioned, the process can be daunting and it needs 100. You can't afford to not pay attention to the details in something like that. And again, it goes back to, what do you want to do? You want to maximize the value of your business. You want to get paid the biggest amount of money for it. So how do you do that? You put your best people on the diligence process. They're going to interact with the seller. They're going to with the buyer. They're going to interact with the professionals. They're going to help market your company in the best light. Now, part of your question also is, to what extent can we outsource some of this stuff, right? And in a small to medium-sized company, you can bring in a professional, such as a outsourced CFO from a fractional firm, but the fractional firms are going to be better at quarterbacking than they are. You know, they don't know the details, the inner workings of the company. They need to quarterback it. They need to ask the questions. They can keep the lists. They can keep the deadlines, because that's a big part of this job. It's just keeping the deadlines is this done? Is this done? Did you finish this? Did you finish this? Did somebody review it? I think the outsourced CFO can do a great job in that. They can do the projections. But in terms of explaining the operations, the relationships with the customers, the way the business, just how we do things around here, that's difficult for an outsider to do.
How about if the people, whether it's the CFO or any of the other professionals, have had a long-standing relationship with the company? So is your point just if they're brought in specifically for the deal?
Yes.
Or in general? Okay.
No, if you've got a long-term relationship, you're part of the team. Then you're going to know those things.
Got it.
Yeah, I mean, it's a team effort, like Bob's saying, and if you in many deals, people will not, the seller will not have the staff already or the person. They may have, they're not going to have a lawyer on staff. They may have, may not even have a CFO on staff. They'll have an outsourced CFO, but maybe that outsourced CFO is, only focused on certain aspects of it. So you're going to have to figure out who it is that are the right people for the team effort, because honestly, anyone coming into the business, clearly, even if I'm outside general counsel to that business, maybe in that circumstances, I know the ins and outs really well and I can feel comfortable. But if I'm just brought in as the M&A deal guy, I'm not going to know the intricacies of this. I'm going to have to rely on somebody, and probably more than somebody, a few people, to walk me through some of these things, because I just not going to know the answers. I mean, again, I go back to those reps and warranties. They're like the heart of the contract in a purchase agreement. And I can tell you what they say and what they're asking, but I can't answer those questions. I don't know if we'll take an example that Bob mentioned, contracts. So one of the key reps in most purchase agreements, especially where the key to the company is like the customers and the customer relationships, it's not just that these contracts exist, but like, has anybody come to you and said that they're thinking of not renewing, or they're thinking of terminating a contract? That is prime example of where I just read a case in Delaware where that issue became a multi-million-dollar issue, because the company, the seller, had information that two major customers did not intend to renew, or intended to reduce the amount of purchasing they were doing from the seller. And as a result, they ended up in a huge litigation over that rep and warranty. I can't know that. Well, Bob's not going to know that. Gershon probably is not going to know that without somebody telling him that this is the problem. So this is why you're going to need, and it's, again, it's hard for the sellers, because the seller is trying to run their business at the same time all of this is going on in the background, often without telling it other people, right? Like, or maybe only telling one or two key employees that this is going on. So in the process, again, it's for someone who hasn't gone through it, it can be painstaking as the seller.
Well, thank you. Yeah, I mean, that story of not sharing material information, I mean, if that wasn't written into the contract, would that be okay? Or would that result in litigation anyway? Obviously, if you say that you don't know anything and you did, then
yeah, I mean, you're responsible for your reps and warranties, but look, I mean, you want to be an open book, and you want to disclose. You're better off disclosing, right? What they always say, like, the cover up is far worse than the crime. Like, if you find it, if there's an issue post closing and the buyer is dissatisfied, and you didn't disclose something, you're going to have a problem, right? And again, part of those reps and warranties, there are things you disclose. So if you say, like, I have no litigation except the following, and you list it, and then the buyer can't come along and complain. Now, you might say, well, I'm really afraid because I have this customer, for example, who's threatening to leave, and it's a major customer. Do I disclose it or not? Yeah, I mean, you're afraid that the buyer's going to walk, but if you do a deal and then it turns out that this happens, the buyer finds out later, you're just going to have a dispute. You're going to have a litigation, which is, going to tie you up and be a problem anyway. So, obviously it's for the seller and their counsel, and their CFO or whomever it might be, or their trusted advisor, to decide what we're going to disclose. and whether it falls within those reps and warranties is something that requires disclosure. But, we tell sellers, like, give us all the information. We'll figure out how to deal with it. Again, the cover up is far worse than the crime.
So let me just mention for a second, Jeff, just to go way back to basics, right? So if there's a rep and a warranty, it's a section of the contract where you might make a statement like this: we are not aware of any material. We're not aware of any material contracts that are likely to not be renewed. Okay, you might make a statement like that, and then you would say, except as disclosed on Schedule, A or B or something like that. And then on Schedule B, you would say, we have received a communication from such and such a contract. We're working with them. We believe we're going to sign it, or whatever it's going to say. But at least you've disclosed it that way. But that's the way the reps and the warranties works. You say, we don't have any of these problems except, and then you list where you have the problems. Jeff, is that a fair, unless you've gone through a contract and seen reps and warranties, the concept is kind of like a little foreign, but that's basically how it works.
Right. And I know this is about due diligence, but understanding, like, it's the due diligence that you do on yourself that then the buyer does on you to then answer and get comfort level with the reps and warranties. And again, if there's something where you have to say, yeah, but, like, we don't have any litigation, but we were threatened, here's the demand letter. Again, better off disclosing that, because if it comes up later, like, if there's a disgruntled buyer, they will, grab onto reps and warranties and as an excuse to, raise post-closing issues. So if money's sitting in escrow, it's going to not be released. If it's, if you piss them off enough, they're going to sue you, like, depending on what how the indemnifications work. So, this is all part of what, the due diligence is going to teach the parties in the deal.
All right. Another question for Jeff. See, then we'll turn it over to the audience. Then we got a quick questionnaire at the end. Due diligence involved, we've talked about financials. We've talked about legal a little bit. Broadly speaking, what are the different buckets that you want to be diligencing or preparing to have diligenced if you're a seller?
Yeah. So when we send out a due diligence questionnaire, if we receive one, these things generally look the same, except that they will also be geared toward the particular business, right? So if you're if you're a tech business and you rely on not just tech to run your business, but this is the product or the service you're selling, obviously there's going to be a tech heavy level of due diligence questionnaire, including someone may actually come in and review your technology and making sure that everything is in order on that way. So it really depends particularly on the business, but the major area is obviously going to be like the foundational questions. These are like, go to the fundamental questions like, how are you formed? Are you, do you have all your permits? How are you in good standing with your, the jurisdiction or the jurisdictions in which you do business? So there's all those like basic legal questions. We don't need to get into those, but sort of the fundamental reps that go in. Employment is huge. Employment from, a standpoint of, what's the nature of your employee census, right? What do you pay them? What's their benefits look like? All these issues. Do you have any litigations involving them? Do you, any unions, things like that? So there are tons of questions that, but then also that has a one-off in terms of like your deferred comp plans and whether you're in compliance with ERISA. ERISA is a major area that can often be a problem in the process. Obviously, like environmental, litigation, contracts. We talked about contracts consume a large part of the what title, assets. If there's real estate, do you own it? If there's assets, do you own the assets? Are they in good working order? What are the exceptions? Your obligations, debt, what are your payables? What are your accounts receivables? Things like that. So you can see like financial statements. Obviously, there's a whole rep on financial statements. This is why, like I said, these go on 15, 20 pages. I will tell you one area that is if there's anywhere, people need to be aware of, particularly because the law is expanding, and that is cybersecurity, privacy, data security. That is a major issue. If you have anything that you involve with Europe, GDPR applies, and if you violate that, forget about it. Same thing, California has the CCPA and CPRA. Like these are, and this is going across. It's a wave across the country. Privacy is a major part. Your intellectual property, do you own it? Do you use somebody else's? Do you have licenses to it? So, I mean, we could go through the list, but you could see the point that this is a lot of, the due diligence all relates to those questions and those reps and warranties. And this is why getting prepared, even in a simple deal, can be very time consuming.
Can I ask a quick question before we jump to Bob? Their big deal, and maybe Bob, you may have something to say on this too, but there's big deals and there's small deals. So, big deals, someone's paying a lot of money and they want to get everything, everything in line. If someone's doing like a $500,000 deal or a $200,000 deal, like doing all 20 pages of work and like really all the work behind all that, what you're describing, that could be like a major portion of the deal. Like how do the economics work on small deals? Or do people just say, whatever, I'm not going to do it and I'll roll the dice?
How can I say this delicately? I don't get involved with $200,000 or $500,000 deals because of the nature, like to do it the way that I think they need to be done. The legal fees will, nobody will be interested in doing it. Not that those deals don't get done. There's a way to do it. You as a seller are going to say, well, I'm not going to do a transaction where there's 20 pages of reps on a $200,000 deal. It's going to just be a simpler matter. And don't get me wrong. I mean, there are scenarios where I have clients who are, buying up assets and we do these things, but those transactions, on the smaller side, they're going to have less reps and warranties. The demands are going to be less. There's still going to be some basic things in there. Like if I can't get title to the assets that I'm paying $200,000 for, there's no purpose in me doing this transaction. So it's you just got to limit it. But I'll say one thing on this and turn it over to Bob. That's why I tell people, like when they come into me and they're like, well, this is a 10 million or 50, or, don't charge me what you charge somebody on 150 million. It doesn't work that way, because in any kind of transaction that's of some substantial worth, particularly where there's a PE firm or, sophisticated buyer, you're still going to go through the same process, and so there's still going to be those reps and warranties. There's still going to be heavy due diligence, because if someone's spending $10 million for something or 100 million, they still want to make sure they're spending $10 million in the right way. And so that's what, you have to kind of, as in my position, have to impress upon the seller that this is just sort of the nature of the beast.
Yeah, the simple thing we used to always say was that the large transactions probably cost as much as the small transactions. It's just, there's a core amount of legal work that has to be done regardless of the headline price. And if you would calculate it as a percentage of purchase price, the big deals are far cheaper to do the legal work than the little deals. I just wanted to mention one other thing, which we haven't really talked about, and it's just a simple process thing. A lot of the way this works is, again, I don't know who's familiar with this or not, but it's very common to set up a data room, an electronic data room, where you give only the professionals that are doing the diligence access to the room, and all this information gets uploaded into a system. And there are organizations out there that run these data rooms, and I'm sure Jeff has plenty of relationships with those. But process-wise, that's how it works. You're in a small deal, you're gonna have a bunch of paper, but on a medium to larger deal, you're gonna have these data rooms. All the information is going to be out there, and it's there for reference. And as a buyer, it's a great thing to have, because it becomes a reference place for you to go when you're running a company to learn things about the organization. The other thing I just wanted to mention is, because we touched on it earlier, but it's really important for the owner, the seller, to run the business the way they always ran the business. When you're going through a sales process, you don't change your method of running the company, because it will impact the value of your asset. Now, if if you have a company plane and the company plane needs to be replaced, you may want to discuss that with the purchaser to see how they feel about it. Is it something they want to eliminate? That, there's oddball stuff or oral exceptions, but in terms of hiring, firing, giving out bonuses, investing in your equipment, keeping your trucks running, all that stuff, it's very, very important that the organization you turn over to your buyer has been running throughout the process the way it always ran.
Otherwise, things are going to blow up very soon. And it's not really a going concern the way it was when.
Yeah, and that's
Came
hard
up
to
with the
do because
price.
you're focused. You're focused on the sale, and a lot of times you're doing the math. If I put this $50,000 in the business, that's 50,000 less to me. But at the same time, if you don't do it, you're risking the transaction. Again, if something's big enough, you talk to the buyer about it and come to a pre-sale agreement on it.
Thank you. Let's squeeze in one more quick question because we have a lot of financial oriented people here, and then we'll turn over to the audience. And this question is directed to Bob, but Jeff, jump in as needed. How much backup do you need for financial representations? So, you're sharing the information, the financial story. I know that we've had situations where the seller claimed something, but then we can't verify it. Obviously, that's a red flag for the buyer and for us, but do you have any general advice or specific pointers on that?
The backup's going to be based on the history. I mean, if you represent that every year we raise our prices on average 3%, you should be able to go back the last 5 years and show the process that you did and you raised prices 3%. If you say our turnover rate for employees, we retain 80% of our employees every year, you can go through the HR records and you can calculate that. I mean, it's the representations on the financials is going to be based on historical trends, which you should be able to demonstrate. Where you get sticky is in the future opportunities of the company. And a lot of times, we used to, I'm sure everybody calls it a hockey stick. You put these projections together and they just go like this. And it's, well, we're going to do this, we're going to do this, and the market's going to change this way. And that's the stuff that you can't really prove. And it becomes a leap of faith. And the buyer is going to discount that stuff significantly anyway. But on the financial information, you're basically going to need the calculations behind it. These are the 30 people that left the last few years. And yeah, it's just math in that case.
Yeah, I would add one thing. I mean, in Gershon, I'm sure you do this, right? Like you have financial statements that people prepare for their taxes, and they're financial statements that you need in a deal, right? And there's a huge difference, and it can be a hard, thing for a seller to understand that, like, whatever you're preparing for your taxes is not what you want to be able to sell and give to the potential buyer or to present to the buyer. So working with someone like Gershon who understands how an M&A transaction works and what a buyer is looking for is going to be key. So yeah, the backup is the backup, but I think like understanding that the buyer is going to need to see certain things from on the financials that you normally wouldn't be as focused, or maybe, even if you're not running GAAP, which, what many a seller is not running GAAP, they're still going to need to be something that's completely different than what you're doing on your tax files.
Yeah, no, the truth is, for running your business also, there's accounting for taxes, and then there's accounting for understanding how the business is really doing. And those two things are not always the same, perhaps always not the same. And they both serve a purpose, but yeah, many businesses that we show up to, whether it's certainly not on the M&A side, just regular business where we come in as CFO, and quite often they're running cash books, which is, again, might be optimal from a tax perspective, but they have to understand how the business is doing. They got to look at it.
But even if you put aside, some of the gray areas, we used to come into a situation where the company when we were selling the company, we had to explain to people how to account for contract rights, because, we sign contracts. When you sign a contract, there's no accounting entry. You sign the contract and you've got a contract. It becomes an asset. But when you sell the company, the contract right becomes valued, it goes up on the balance sheet, and then it gets amortized and it goes through your expense. So you have to explain to people why you're adding back contract right amortization, because it's not a real expense. And it's a different accounting entry when you sign the contract versus when you sell the contract, right? So this isn't getting into the gray area of, is this person really working, not working, you know, why is my grandmother on the payroll, that kind of stuff. There are real business issues where you have to reconcile the GAAP financial statements to what the business truly generates. And those are really important to stay on top of.
Thank you.
And then I actually had a question related to that, if I could.
Yeah, well, I was about to segue into saying we're going to do some Q&A now. So go ahead, Chris. I'm going to put up the poll, and we'll be here for a few minutes as people ask our amazing panel questions.
Well, and so
Chris,
this is just sort of going back on that, because Bob, you mentioned make sure you're running the business the same way you have leading up to the sale. But I've always heard that, what we're just touching on, running a business to minimize taxes for the shareholder is different than running the business to maximize EBITDA and whatever for sale, that kind of thing. So I guess, how do you, I think we're sort of talking around that here. I mean, to me, you have to sort of pivot a little bit and manage the business a little bit differently, because again, minimizing taxes, from a standpoint versus positioning it for attractiveness to a buyer. What are your thoughts there?
Well, I mean, I guess what's going through my head as you say that is, let's say you're in a cash business, right? And a piece of the revenue doesn't always find its way to your books, right? Because it's cash business. You're right. Some of those owners might 2 or 3 years before they sell the company begin to manage that process a little bit differently. But that's not what I meant. What I meant was operating the company. What I meant was,
yep.
I mean, you're 100% right. If you've got funky stuff going on and things aren't making it to your company books and records, yeah, you may change that 3-4 years in advance and sort of manage that process. I've seen that. But what I was talking about was the decision to maintain your fleet, to that kind of stuff.
Invest in people, all that kind of stuff. Yep.
Yeah.
Okay. Yep.
Yeah. I mean, I think on that is that the point is that, again, before you present the financials to the potential buyer, you're going to have to work with your CFO, your outsourced CFO, your fractional CFO, whomever it is, to get the financials in order to make sense with respect to what the buyer wants to see, right? Like, because there are things like add backs. How do you account for like prepaid expense, like all this stuff that you're not necessarily thinking about. A lot of businesses that are worth a lot of money are a couple of owners that tend to use them as like ATM machines and run their expenses through it. Like, that's just going to have to be revised. That's not going to work if you want to maximize the value in the sale process. So I totally agree that there are going to be some things that you're going to have to adjust. And if you're thinking of selling, you should probably be thinking about that way ahead of time before you have to do that.
All right. People, the poll is up. If people can just give us 10 seconds of feedback, that would be great. Anyone on this call who would like a complimentary 1-hour session with one of the CFOs on our team, check this box over here on the poll or reach out to Brittany to set that up. Thank you to our amazing panel. And again, any more questions? Does anyone else have anything they want to jump in on?
Yeah, I was curious, speaking of like a small deal, let's say, I don't know, definitely under $1 million. If there's no company, it's just like a technology asset. Is it okay to, if there's a patent, whatever, is it okay to just use the same IP law firm to engage for engage for the sales of a patent for some tech thing? Or is it necessary to go through some financial XYZ? Yes, that's the,
I would answer that by saying, whatever you're doing in an M&A, a sale of asset, whatever, even if it's a very specific, if it's a patent, whatever, just make sure that that firm, that lawyer knows how to go through the process. I mean, yes, like if it's one particular asset, or if you're just selling like a customer list or, some equipment, a basic lawyer should be able to understand how to do that. In the IP context that you particularly raise, I would think like, a decent IP lawyer is going to know how to sell the patent, and it's going to be a fairly simple contract in that case. But, the main thing is there's too many times where it's in transactions where it's the lawyer is somebody who's been perfectly good for the operation of the business along the way, but doesn't understand the deal. And those are the worst. Those are where the legal fees actually become worse on a proportional basis. Like when I do deals and the other firm on the other side has gone through this a million times, like I have, that process runs so smoothly. It's a big difference. If you have someone who hasn't been through it, whether it's on the, financial side, CFO, the lawyer, whatever, you are going to drag down the deal and it's going to drag out. Hopefully that answers, but I think you kind of get the sense of it.
yeah. Excellent. Thank you. Very insightful there. Yes.
All right. Any other questions? Any other questions? Anyone else who wants to fill out the poll? Feedback is helpful. All right. If we don't have any questions, thank you all for joining. Thank you to our team. We have a whole bunch of people from our team. We've got Barry, Steve, Mark, Ken. Thank you all for joining. Thank you, Barry, for your story. And thank you, Bob and Jeff, for coming and doing another amazing and entertaining webinar for us, with us.
Yeah.
And yeah, if anyone wants to speak to Bob or Jeff or one of the CFOs on our team, a bunch of you answered. I'll leave the poll open for a couple more minutes or moments, and then we will end that. All right. Be in touch. Have a great day, everyone.
Thank you.
Thank you.
Thank you.
Bye now.
Bye-bye.